you, Brian Hayes.
Governor Carney, welcome to the Econ Committee, and thank you for your observations and your presentation. Can I ask a number of questions in your role as Vice President of the ESRB? You recently said, I think with other colleagues on the 24th of November, following a meeting, that there were two principal issues that the ESRB had highlighted. One was on the question of priority action on Solvency II. And I'd be interested to get your thoughts on that, because in reply to Mrs. Swinburne earlier, you made the point that you thought there were few unintended consequences. Given the fact that we've had to put in place in this House a mammoth number of legislative files to deal with the crisis, to deal with the systemic threat that was there, what is your view about looking back on those files, looking back on the real adaptation of those legislative decisions to make sure that they're working, make sure they're fit for purpose? And do you see the role of the ESRB in marking out things that are not working so that it is clear in terms of the systemic risk principle, which is at the heart of your work? And then secondly, I come from a country, Ireland, that you're very well aware of, as I understand, and you know, as I do, the extent of the real estate crisis, which effectively was one of the contributing factors behind our own crisis in Ireland. And you have said recently, with your work in the ESRB, that you're looking again at the risks relating to the real estate crisis. I understand you'll do a piece of work on it, which you will shortly publish as well. What do you see as the potential spillovers here, given the fact that high loan-to-value ratios, favourable tax treatment in one member state or the other, or indeed the high question of banking leverage? Where do you see these potential spillovers? And do you believe that it's the mandate of the ESRB to mark out those spillovers where they emerge?
Okay. First, a few comments, if I may. First, I had the article "A few." There are a few unintended consequences of financial regulation, and I suspect we will discover some more as more of it is implemented and bedded down. And as I said in response to an earlier comment from one of your colleagues, that as the system evolves, as there's innovation in the system as well, and we have to be conscious of that, and we have to come back to Parliament and explain if we think things should be adjusted or supplemented, why that is the case, and draw the line from the original intent of original legislation or legislations and how they work together. One area which touches on that, which is an area of focus for the ESRB, is around market liquidity and the potential fragility of markets. And by fragility of markets, I'm referring to these periods that we have seen over the course of the last few years of temporary bouts of illiquidity in markets, sort of jump to illiquidity in markets. Why that is the case, how that interacts, to what extent there is a regulatory cause versus a change in trading strategies, developments of asset managers, other factors that might be there. And we need to tease that out. And we're doing some work at the ESRB. More work is being done in other jurisdictions or at other bodies, including at the ECB and at the FSB on that. And we have to come back and be clear about where we think items, whether it could be a leverage ratio, whether it could be some of the liquidity metrics, or whether it's more a product of the nature of markets that have become increasingly electronic. And you have the combination of darker pools and lit markets that occurs. In that regard, just to touch on that, and I'll get to real estate, is that I referenced in my remarks the ESRB is following up, doing its own version of a survey of funds and their behavior potentially under stress in a stress scenario. So whereas the Bank of England surveyed around 150 funds, and they're sizable funds, and we got some insights, the ESRB will be able to survey about 2,000 individual funds, so individual funds managed. So it gives you a sense of the scale and the insights that come from that, and that will feed into this market-type liquidity work, a variety of other factors. On real estate and spillovers, and I don't have time to do it justice, but the one point I would make is around reciprocity. This really does underscore the importance of reciprocity, because let's say a national central bank, such as the Bank of Ireland recently, takes measures to restrict loan-to-value, loan-to-income metrics on real estate lending, but that isn't reciprocated by other jurisdictions. That isn't cleared through the SRB. We don't follow, and there is effectively regulatory arbitrage develops. And as you know, the non-bank sector can be dead one day and then very much alive the next day. We can't have that type of regulatory arbitrage. We have a very clear mechanism for the countercyclical buffer and reciprocity. We have the clearinghouse with the SRB for broader macroprudential measures, such as the ones I just referenced, and we really have to make sure that works. And that is, I will provide some reassurance that that is very much the spirit of everyone around that table in order to make it work. But that would be one example of a spillover that could happen.